Everyone. This is Fausto, and you are back on the Cyber Expo Guru Show. And looking forward to have our new speaker here. We did our big event last week. We had Greg Capper today. I'm really looking forward. We have Elliott Gue going to talk about something different that we really ever have here. We talk about gold, we talk about stocks, we talk about options, but we never ever really talked about energy as much. So I think this is a really exciting podcast that we're going to have really quick, because I need to know a lot about what's going on with oil, especially with the new administration coming in. We saw oil spiking and coming down a lot. So Elliott, well, welcome to the show, Elliott. How you doing?
Good. Thanks for having me on.
Good. Thanks for being here. So what the hell's going on with energy? I mean, like, my God, how does the energy go up the way it does and comes down the way it does? I mean, I know you run a big, very famous newsletter, and everyone, loves it, but like, how are we getting this volatility, and is it going to continue to go lower?
Well, I mean, it's one of those things where I think, politics gets caught up a lot in the energy markets. People talk about, for example, when after the election, there was a lot of talk about this whole drill baby drill idea, and the idea that there was going to be this big surge in U.S. oil production that could potentially threaten, push supply and cause oil prices to go down. And then you also had people saying, well, but Donald Trump is good for energy stocks. So people were buying energy stocks for that. I think people focus too much on the politics of the situation. It really is just about supply and demand. If you actually listen to the conference calls from the major U.S. oil producers, you'll hear over the last several years, really, that the problem hasn't been something the government's doing specifically that's prompted them not to drill more aggressively. It's been price. They'll drill more aggressively. They'll produce more oil if prices are high enough to support that. Right. So, if prices go down, they drill less. And so what have we heard about this year? All the major producers are out there talking about cutting their capital spending, drilling less aggressively, cutting growth in supply, and really deferring drilling activity until prices are healthier. So I think it has less to do with politics and more to do with supply and demand and price, which is pretty much what rules commodity markets and has for since the dawn of time, right?
Right.
People get focused on everything from OPEC to geopolitics to U.S. politics, and mostly that stuff just doesn't matter. What matters is, what's the price of oil? Can producers make money at that price? And what's the supply and demand balance? Right now, oil prices have taken a big hit. Especially we had that spike around the geopolitics-driven spike we had in late June. But again, that's mainly a sideshow. Historically, geopolitical spikes in oil have been short-lived, and oil prices revert to the trend they were in prior to the geopolitical event. The real issue for oil that's caused it to be weak is that there's significant growth in supply coming out of OPEC, or fear of significant growth in supply coming out of OPEC. And there's been some concerns on the demand side. Will there be a U.S. recession? Will there be a global recession? And that's pressured the price of oil. I don't think oil has a lot of downside from here, for the simple reason that there's been a lot of talk about new supply, but these OPEC production hikes that we're seeing have been much more limited than it says on the tin. OPEC comes out and says, oh, we're going to increase production over 500,000 barrels a day in August. But the real actual production increase is far lower than that, maybe 20% of that.
Okay.
At the same time, I think demand has been a lot more buoyant than many expected. And, we're seeing global oil inventories on the commercial side, actual companies, near multi-year lows. So I actually think the oil market is fairly well supported here.
Well, I'm going to ask you Elliott, I'm going to ask you a lot of stupid questions, because there's a lot of people in here that are listening in that really just don't understand the concept of like who is OPEC and why do they do this, and why did oil, like several years ago, go negative? Mm-hmm. And what's driving it up? And when you're telling, like, you're saying, like, is politics really involved? So, don't mind me or asking, because these are the questions I've been getting from a lot of the people that are in the room. Sure. And as an educator, sometimes, like, as an educator, like, I get people ask me, like, what is the bid and offer? you know,
Right.
and like,
Sure.
and you're like, well, if you don't know what the bid and offer, they shouldn't be trading, but you can't argue with them. I just had someone ask me the other day, I have a home living channel, and I said this yesterday. I have backyard chickens. People are like, well, do you need a rooster for a chicken to lay an egg? And I'm like, unless you want it to get pregnant, you know what I mean?
Right.
No, you don't. And they're like, well, I didn't know that. Not that they're just, some people just don't understand because they're not in that business. So explain to me, like, who is OPEC? So people understand. You hear about it all the time. You know, who are these people, and why is everything controlled around them? Why can't we do our own thing?
Well, OPEC, the Organization of Petroleum Exporting Countries, was founded back in the 1960s. And what it is a group of large global oil producers, led by Saudi Arabia being the biggest. And what they found was that back in the early 1970s, the price of oil was very low. And because a lot of these countries were sort of overproducing, dumping oil in the global market, U.S. oil production growth up until 1970 was very strong. In the early 70s, U.S. oil production rolled over. I actually have a slide about that a little
So we
later
had that
on.
crash in oil. That's we had the Contra thing. Was that when we had that? Gas was like a gazillion dollars a gallon.
Yeah, we had, we actually, yeah, we had, in the early 70s, we had this growth in supply, and demand was growing very rapidly, but their supply was growing fast enough to meet that. But as supply started to roll over from countries like the US and other sort of friendly Western countries, what OPEC found was that they could control the price of oil. By
Right.
restricting their own supply, they could drive up the price of oil, and there wasn't anything anybody else could do about it, right? Because if they controlled most of the world's supply, it takes time to bring a new oil or gas project online, right? Especially
Mhm.
back in those days. So there was no way for the Western countries, the United States, Europe,
Yeah,
to
Canada.
respond by increasing production. In commodity markets, energy in particular, I like to say that supply is very sticky. Demand can turn on a dime, right? You have a recession, like 2008 or even 2020, right? When oil prices went negative, demand drops off a cliff. But then as soon as the economy recovers, demand for energy recovers because we use it for literally everything, right?
Hmm.
But supply takes longer to adjust. You can't say, well, I'm going to go out tomorrow and find a new oil field somewhere and drill it, and then a week next Tuesday actually start producing more oil. It takes years.
Right.
So, what happened in the 70s, right? What that historic inflation we had in energy prices, right, was that OPEC was able to control their production, and there wasn't enough supply elsewhere around the world to meet global demand and global demand growth for years, right? And so OPEC was able to push up the price of oil. By the late 70s, early 80s, finally, a lot of the investment that had put into new oil and gas production during the 1970s was coming on stream. So we had Alaska, right? North Slope. We had Mexico, Cantarell oil field in the Bay of Campeche. We had the North Sea of the United Kingdom and Norway. We had all this new supply. Oil prices came down. One of the things you learn about looking at energy markets from the long history is that these are typically very long cycles and a lot of distraction out there, but it's really all driven by supply, demand, and price.
Hmm.
Right at the top of the cycle, you have oil prices are very high, and so you have lots of producers are incentivized to go out and produce more oil. So they do that to meet that high, so they can take advantage of the
Which is,
high
I'm kind of
price.
confused, Elliot, not to cut you off, but that's where I'm a little
Yeah,
confused. I think the people here that listening in, because, like we trade stocks, and there's a lot of stocks that do trade, not just more of a commodity, but more of the stock version of it, and
right.
energy stocks. And we could talk a little bit about those.
Sure.
But like when it comes to how does like OPEC just come out there? Well, first of all, let me just say this: would you say OPEC is like let's say like a NATO or like the G7 or something like that, like a group of different countries that are working together on how to control the market?
Yeah, I would say it's often called a cartel, which is basically what it is. But it's
A
also
good cartel.
well
Maybe.
for them.
But
But
then,
yeah, it's a little bit it's a little bit more difficult than that, or a little bit more complicated than that, because OPEC, the countries don't necessarily always work together, right?
Right.
So a lot of countries in OPEC now, back in the 70s was different, but now a lot of the countries in OPEC really don't have a lot of ability to control their oil production. Most of them are producing pretty much flat out as much as they possibly can all the
Of course, you
time.
would think so. I mean,
Right. And so they have a history of cheating on their quotas. So OPEC as an organization sets quotas for a country. They say, you can produce 3 million barrels of oil a day, right? And so they say, if supply is excessive, they might cut that quota to try to push the price of oil up to try to reduce global supply.
how
Most
many
countries don't do that.
how many are part of OPEC? How many countries are there?
Well, there's OPEC, and then there's the OPEC plus, right?
Okay.
And so you have these sort of 7 or 8 core countries in OPEC, and then you
Okay.
have a few more that are part of OPEC, but nobody cares because they produce flat out all the time and they don't really manage their own production. And then you have countries like Russia, for example, being the largest, that are not part of OPEC, but they're part of this wider OPEC plus group.
Is Iran part of it?
Yes, they are part of OPEC. They're one of the
Okay.
core members, but
Okay.
again, their production, their ability to control production is severely limited by sanctions, but also the age of their oil fields. You got to remember that one of the issues for a country like Iran has been that not only have they been prohibited from exporting oil to certain places around the world, but also the Western countries, the big Western country companies, right, producers,
Right.
haven't been in there to help them with the technical side of those oil fields for many, many years now,
Yeah,
decades.
technology. They probably make like so that's what they say, like you have dirty oil, something like that.
Yeah, it can be that, or it can just be that the equipment is old.
The old.
Oil field technology is advanced. I mean, people think of oil as being energy as being a really backward industry, kind of old economy, right?
Right.
But it's actually super high tech, right? So we've made a lot of advancements in drilling technology and how we manage oil fields over even the last 5 or 10 years, right? And so by deploying some of these technologies, you can actually keep producing at a higher rate for longer. You can produce new areas of fields, but without that investment and without the access to that technology, your fields age and you see a natural decline in production over time. So Iran has that difficulty. I will tell you, the only country that you should pay much attention to at all in OPEC is the Kingdom of Saudi Arabia. They're the
Okay.
only country in OPEC, and a couple of their very closely allied Persian Gulf states like Kuwait, for example, the United Arab Emirates, but Saudi Arabia being the biggest. They're the only country that actually manages their production to try to influence prices on a consistent basis. Everybody else does a lot of talk, right?
Right.
But you never know, but they're not necessarily managing supply as they agree to within OPEC. So the most important thing when you're thinking about OPEC is just to watch what the Saudis are doing,
Okay.
what they're saying, but more importantly, what they're actually doing.
Okay. So when you do your newsletter, are you focusing more on like Saudi Arabia, or are you focusing on what's going on in Russia, United States? Because I know Canada's also. I mean, we have a lot of Canadians, here
Yeah.
too. I mean, that's a really big part of their business in Canada is energy, especially on the West Coast, up in Calgary and stuff. But how does that all come into fruition on judging the price of oil? Like, do they compete with each other? Like, I mean, how does the United States and Russia come into the play? Like, could they manipulate the price? And like, how do they work together? Like, with all these cartels?
Well, the U.S., for example, U.S. producers are not influenced by what OPEC does directly. I mean, OPEC doesn't have any control over what U.S. producers do. U.S. producers nowadays are not aligned in any way in terms of a concerted effort to increase or reduce oil supply.
Hmm.
It's all market signals, right? So it's just the free market. If the price of oil is very high, producers are going to want to try to produce more if they can. Not all producers have the ability to increase production. If the price of oil is low, they're going to try to cut capital spending and preserve free cash flow. So the U.S. producers, a lot of what I do is actually qualitative as well, listening to the conference calls, going on the web and reading the conference calls if you can't listen to them in real time. And, listen to what the big companies are saying. Are they drilling in the U.S. more? Are they cutting or increasing capital spending? Shale is different than other forms of energy production. I liken shale to a manufacturing business. Traditional energy or conventional oil exploration, you go out and you find a new field, you build a bunch of infrastructure, pipelines, drilling rigs, all that, you produce from that field over time. It takes years to bring it in production. You produce at a plateau rate for a long period of time with low operating costs, and then eventually it matures and declines. Shale is really a function of the oil and gas is widely distributed.
That's
it's not a
fracking.
matter of finding it. We know it's there.
You mean like fracking?
Yeah, you fracture, but it's just a matter of capital spending.
Okay.
If you want to go out and drill more wells, and what we call fracturing wells, we call that completion, completing a well. You go out and drill and complete more wells, you're going to produce more oil. It's that simple. So it's in terms of whatever you want to spend will determine how much you produce. But U.S. producers, how do they plan on what they're going to spend? It's solely a commodity decision, right? If the price of oil is at 80 and their break-even costs are in the 40s, say, they can make X billion dollars of free cash flow. And so they're going to target their capital spending to a level which maximizes their free cash flow at any given price. Now, if the price of oil drops to the 60s or 50s, as it did briefly, a month and a half ago, you're going to see them cut back on their capital spending. It really is that simple. The OPEC countries, your international producers, again, Saudi Arabia, it's their attitudes, their strategy is going to depend on what they see in terms of supply and demand globally, what they see the U.S. producers doing, what they see the other major, countries like Brazil or Guyana doing. And they're going to set their production policy accordingly. They do not want global oil inventories to expand too much because that's going to lead to crashing prices. But at the same time, they don't want to prop up oil prices too much such that it encourages the U.S. producers to produce more aggressively. So they're always trying to kind of find a balance.
So it's a game.
It is a little bit of a game. It's kind of like a game theory, right? If you produce more, you might attract the wrath of OPEC, a wrath of Saudi Arabia, and they might decide to overproduce to drive down the price of oil. That's kind of what happened in 2014, 2015. If you remember, the price of oil went from $100 a barrel down, ultimately
negative.
down.
Didn't it go negative at one day? I remember it was like negative.
It did in the 2020. It did on a physical basis in the front month futures. The longer term futures never went negative. But
right.
Yes, yeah. In 2020, you had a situation where demand collapsed because of COVID lockdowns. And at the same time, you had Russia and Saudi locked in a price war, both sort of overproducing. And it caused a supply-demand imbalance that was of epic proportions, caused the price of oil to collapse. That actually marked the low of the bear market in oil that started back in 2014.
What was the low on that day? It was like negative 40 or something like that?
Yeah, I mean, the front month futures were down in the negative 40, negative 50 range very briefly. But I mean, if you look at the long, I tend to, for companies, the more important thing to look at is what we call the strip price of crude oil. And I don't know how familiar your listeners are with commodity markets, but for oil anyway, and natural gas as well, we have futures for delivery every month of the year. So you can contract for oil for delivery in August or, July of next year, whenever.
Right.
So with the producers, usually they're hedging. A lot of them are hedging some of their production.
That's how the airlines do it. The airlines do.
Yeah, right. Airlines, natural gas producers. Yeah, everybody does it to an extent. Companies that make cereal hedge the price of the agricultural commodities. And so they're locking in those prices, quarters ahead of time in many cases. So they don't really care about what the front month price of oil is in a situation like that. They care about what the average price of oil is over, say, the next 12 months.
Hmm.
So when I'm looking at energy stock, if you're trading futures, yeah, that was really bad, negative pricing. But if
I
you're
was trying to
trading the
buy it. I
stocks,
couldn't
it's a
get
little
it.
different.
I didn't. I was like, what? Okay, let's go through my account, like, because I knew it was going to go up. I mean, it was obviously it was like because
Yeah.
we're day traders, so we see stuff like that all the time, and like I never really trade more of the futures or the oils. I'm like, my God. I mean, even I knew that, but
Right.
that was pretty historic.
That was historic. I mean, we've certainly never seen it in modern times before.
Yeah, you could see it again, but you never know if something happens. But regarding about oil, like right now. So
Mhm.
what do you? I mean, like, how does it? Why is it change in such dramatic price? So you say, well, if a Democrat gets in office, United States, like you see, I remember it was at 120, $150 a barrel. Now you have a Republican, in office, and now you drop down to like you went from like the high 70s and now 80s. Now you're down to the mid 60s. Like what is influencing it? I mean, you're saying like, is it they're manipulating to make sure they don't make it go too low, make it go too
Um,
high, or find the balance?
I mean, again, I think the politics is often overplayed. I mean, a couple of classic examples. Remember back in 2008, before Obama was elected, before the presidential election, there was all this talk about Obama wanting to kill coal.
Right.
In 2009, 2010, what were the best performing stocks within energy? Coal stocks,
Yeah,
coal
that's when they
producers.
ask you that. But sometimes you're looking at that stuff and you're like, it's just like it told us the opposite.
Yeah, some of the best performing stocks in Donald Trump's first term were alternative energy stocks.
Yeah, I'm seeing
Some
it
of the
right
best
now.
performing stocks during Biden's term were traditional oil and gas stocks. I think politics is a sideshow for the most part, especially U.S. national politics. It's all about emotion. The reason you hear so much about it, I think, is that it attracts a lot of attention. Right? Nothing attracts attention like emotion.
Hmm.
So if you can scare people or sort of instill greed in them, right? You can attract a lot of attention to a media broadcast, for example. But the reality is that what's going on under the surface is very different. I like to focus on that actual supply and demand conditions, and I also like to look at sentiment. One report that I look at very closely, it comes out from the Commodity Futures Trading Commission. Um, which is the Commitment of Traders report. You may have heard of that, but basically it looks at the net position or the positioning of traders in in futures markets, whether it be oil or corn, whatever. And you can look and see, the speculators and also the hedgers. The non-commercial traders are the speculators. The hedgers are, we call them commercial traders. And you can see how they're positioned. Are they long or short oil futures? And one of the things I look for is a situation where the price of oil is very low and the speculators are heavily net short oil. That's usually pretty close to a bottom because
Okay.
if everybody's bearish on oil, yet oftentimes you'll look at the actual supply and demand conditions and they're either can't get any worse like 2020 or they're improving like now. Uh, and that's often a good buying opportunity in oil. On the flip side, you'll see times like early 2018 is a good example. Um, you had speculators heavily net long oil because they were all excited about OPEC managing cutting supply. And in reality, the supply demand balance in oil was weakening at
Hmm.
that time. And so the price of oil came down. And again, it amazes me how often you'll see the political narratives out there not match up with what's actually happening on the supply demand balance, right? So you'll have situations where people say, oh, there's a Republican in control of the White House. I'm going to go out and buy Exxon. And then Exxon underperforms for the next 4
No, it
years
does. It
or
really
vice
has. I don't
versa.
think it has really gone anywhere, has it?
Exxon's been a great stock to own. I think it's still a great stock to own for a long-term perspective, but it hasn't gone anywhere in the last couple of years because of what's been happening in the commodity market,
Right.
in the oil market. And Exxon is kind of unique among the big producers in that they're one of
Is
the only
Chevron or one
ones.
of them?
Sorry,
What about Chevron? Like same with the Chevron?
Chevron is close, but I think not quite as good as Exxon in terms of their
Okay.
potential to grow production. One of the things that the big companies traditionally have done is that when oil and gas prices are weak, they invest a lot in new production. And then when the prices recover, they get this cash flow windfall. But for some reason, and there are a few different reasons why, in 2019, 2020, when prices were very low, went negative, right? A lot of these companies were not investing. Exxon was one exception. As a result, they have a much better production growth profile than any other major producer in the world.
Now, regarding about profitability,
Mm-hmm.
isn't it that they can't have oil go under $50 because that's when they're still making money at 50? Is that what's a sweet spot for them?
Well, it depends upon what producer you're talking about and where they're producing. Most of the big oil companies, like your Exxons of the world, the way they operate is they invest in these long-term multi-year type projects, and they assume a low price of oil. Usually, it could be $40 a barrel, somewhere in there, or
Okay.
even under $40 a barrel. And they say, okay, at that price, this project still can make sense for us long term.
Okay.
The shale producers are, because of the nature of the shale business being, they can respond, they can increase or decrease production more quickly than the traditional producers, the conventional producers. So their break evens are a moving target, in the sense that, when I analyze an energy producer from a fundamental standpoint, what I look at is their total cash costs of production. So, whether that be the cost of drilling and completing new wells, which is in CapEx, all the way to interest costs, the cost of maintaining existing wells, all this is in their accounts. And I try to calculate a break even. What do they need in terms of oil prices to produce zero free cash flow? So to cover their costs, but not make any excess money. And a lot of these companies, they only need oil prices down in the 40s, or even lower than that, to break even on a cash flow perspective.
Okay.
But their behavior is it's more nuanced than that. At $50 a barrel, yes, they can break even, but nobody wants to just break even or make a little bit of free cash flow.
Of course.
And they don't want to drill through all their inventory of wells at $50 a barrel when they think that oil prices might go to 80, in a couple of years' time, and they can make a lot more money. So they're going to set I think this is a mistake a lot of investors make. They think, well, their break even is 45, so oil prices can go to 45. Not really. If oil prices go to, it's not like they're going to wait until oil prices go to 45 to cut spending. They're going to start cutting spending at 70, right?
Oh, wow.
And
okay.
if it goes to 60, they're going to cut more. If it goes to 50, they're going to cut more. If it goes to 40, they're going to be in, free cash flow survival mode. Even though they could theoretically break even, they're going to be cutting capital spending very aggressively, trying to shore up free cash flow.
I'm glad you cleared it up, because I think a lot of people here probably always wonder, like, oh, they're all going to go out of business. And you get these people like, the anti-oil and stuff like that. Mm-hmm. So at least now we know a little bit more about where they're even and how they obviously, it's like a credit card. You just take, the wife keeps spending. I'm just going to keep cutting it down.
Right. Right. It's not a light switch, it's more of like a dimmer switch. So
switch.
The higher oil prices go, the more you're going to turn up your CapEx. The shale producers really, they have an accelerator. They can push CapEx. They can spend more money. Investors hate it when a producer comes out and says, we're going to spend more money to grow production if the prices aren't there to support it.
If it's not there,
the stock will get creamed. But if they're spending more money and growing production at a measured pace because prices are high, that just means they have this avalanche of free cash flow. The stocks start going up because they start buying back stock, paying dividends, whatever, to try to increase shareholder value. But it really is very much an economics thing. If you want to see more production, let the price of oil go up. You want to see less, let the price of oil go down. So,
just turn things around a little bit now, because I think a lot of people want to know this, and that you obviously analyzing this more than better than anybody in your newsletter. With all this, you just had the Obama administration, left, and they had the whole Green New Deal. Like I live here in Long Island, and they build all these windmills, out there, and how is that going to affect oil right now? Is that going to, with all the solar panels and everything out, battery cars and all that? I mean, where do you see oil in the future? Are these people still going to survive? Is it still going to be around? Are they just going to cut production? I mean, I don't see it really going anywhere as much anytime soon. but where do you see the future at? And not only that, I mean, nuclear has been taking off. I mean, I don't know if that has anything to do with it. I mean, nuclear stocks have been watching them just recently, which I'm a really big fan of, but where do you see all that coming into fruition?
Well, I would look at the big three fossil fuels, which is your oil, your natural gas, and your coal. And just remember that they're the bedrock of the global energy system. It's more than 80% of global energy supply comes from those three fuels. So I think the bigger risk than renewables, a lot of times this debate boils down to, and often it's tied up again in politics, just like everything else, right? But it ties down to this debate between renewables versus, natural gas, oil, and coal. Or mainly right now, it's renewables versus natural gas, right?
Right.
And some nuclear. But the reality is, if you actually look at the data, right? The narrative is, well, we're going to replace, natural gas and oil and coal with solar and wind, right? And maybe some of these other things like tidal power and things you occasionally hear about, and nuclear. But the reality is, and there are a lot of people will tell you, well, that's already happening. And you see these charts. I think I have one on the deck here in a minute, but Chinese solar energy capacity is growing at a parabolic pace and much faster than any other country in the world, including the United States. 40%, more than 40% of all solar energy generated in the world is generated in China. And the US is a distant number two. And everybody else is sort of a rounding error. But the reality is that doesn't tell you the whole picture. If you look at where they're actually getting most of their energy from, it's still, coal, natural gas, oil. If you look at what's meeting, because China has rapid growth in demand for energy as well, some 50 some exajoules over the last 10 years alone. And almost all of that is being met by growth in coal production or capacity, growth in natural gas, and growth in oil. Solar is, I think, the fifth way down. It's less than 30% of the growth of, say, natural gas over the last decade. So when you look at these charts, you see them in TV, for example, this sort of parabolic line. It looks like, oh, wow, there's this huge energy transition going on worldwide. There is an energy transition. It's just much slower than most people think. And I think the bigger risk especially the next 10 to 20 years, isn't that you're going to see a disruption from renewable energy of traditional oil, gas, and coal. I think the bigger risk is complacency, right? It's that people are going to have this idea in their head that, renewables are the future. They're going to meet all of our energy demand growth, whether electricity or transportation fuels. And the reality is that they can't and they won't. And that if that causes a decline in investment in traditional oil, gas, and coal, there's just not going to be enough energy out there to meet growth and demand. There's not going to be enough of these commodities out there.
But there are people out there, Elliott, that think that it is, aren't there?
Well, there certainly are, and there's certainly a lot of people talking about it. And it's sort of, if you will, the consensus view. If I had $1 for every time I've read an article online or in a major media publication or heard a story about the energy transition, I would be a very, very rich man, right?
Yeah.
But you very rarely hear it. But if you look at the actual data, one of the things I like to encourage even my readers of my services to do is don't even take my word for it. Look at the actual data. Go to the actual source. Look at the data. Look at energy demand growth, right? Whether it be in the United States or China or Europe or anywhere. And look at what's meeting that demand, what commodities are meeting that demand. And you'll see that though there certainly none of the charts that you see on the media are a lie. Chinese solar power generation is growing at a parabolic pace, but it still accounts for less than 2% of Chinese energy supply.
Right.
And it's not meeting very much of the growth in demand. All of that's coming from oil, gas, and coal. And so I think the bigger risk is that you continue to see, because we've already seen it, countries sort of discourage investment in traditional fossil fuels, and then rely too much on renewable generation, which is intermittent, and end up seeing price dislocations as a result. Europe is a classic example. For years, Europe talked about rolling out all this new renewable power. Germany in particular, wind, solar, mainly wind in Germany, closing down their nuclear power capacity, not building any new coal, closing down coal plants, not building any new natural gas plants, and then relying solely on imported gas from Russia. And we all know how that turned out, right? Russia
Yeah,
invades
yeah.
Ukraine. Suddenly that supply is cut off. They're scampering around trying to find it from the United States or the Middle East. Prices go through the roof. And Germany has had this epic blow to their industrial production. Electricity prices in Germany are more than 4 times as much as in the United States on average.
Is it that high?
It is. And
My
it's
God.
even for you and me, that's bad, right? Nobody wants to pay 45 cents a kilowatt hour for their power compared to 11 or 12 cents here in the United States. But imagine for a company that uses energy to produce manufactured goods. I mean, when you think of Germany, what's one of the first things you think of, right? They're a
Mercedes,
manufacturing superpower.
BMW. Yeah, you did cars.
Cars, chemicals, all sorts of valves and pipes and fittings that are used in
Right.
all sorts of industrial equipment. And those are very energy intensive businesses. And they're the core of the German economy. And they've really suffered from that. And it's going to be difficult for them to recover. And so I think the bigger risk is that people get too excited about the transition and neglect what remains and will be for at least the next 10 to 20 years anyway, the core of our global energy system, which is, again, your coal, your gas, and your oil. Obviously, natural gas, I think, is a very exciting market from a growth standpoint, because natural gas is much cleaner than coal, obviously,
Of course.
and it can replace coal to an extent. We've done that in the United States to a large degree. Coal, not long ago, was the largest source of power generation in the United States, and it's shifting in favor of natural gas being larger.
Yeah, we're having a problem here in New York, though. I mean, they were trying to build that big natural gas line here in New York. They cut it off. Here in Manhattan, I mean, they don't want anybody on gas anymore. They won't let you
Right.
put any gas or anywhere. Things got electric, but then it's like, where you can get all this electric? Like, I just looked at a video just the other day. I'm going to be going. I do a lot of fishing here on Long Island, so they put all these windmills out in the ocean, and they killed probably. They didn't want to say it, but it killed like probably about 30, 40 whales over 1 year. We haven't had that ever in the
Right.
history.
Yeah,
And they're trying to say,
terrible.
oh, that was just an anomaly. We know why it was. But now it's going to end up happening. They have these big monster windmills out there, and they think that that's going to support New York, and it's not. I mean,
Correct.
what happens when one of those things fall down, whatever it may be? I mean, things break, right? So,
Right.
I mean, and then it's a lot of moving parts, right? I mean,
It is.
so
It's very complicated.
it is, and you still need oil to run them. You still need someone to run them. But then, like, but they cut the gas down. I know you're a big fan. I'm a big fan of gas too, but they don't want you to have it anymore. So
Right.
what's next? Nuclear power?
Well, nuclear is going to be part of the solution. Certainly, countries like China are aggressively pursuing nuclear still. The problem is time to market. It takes a long time to, especially in a country like the United States, to site and build a new nuclear power, new nuclear reactor. So it does take time. I think nuclear is going to have to be part of the solution. And I think that some states, New York being one of them, if you look at here in the United States, if you look at individual states, look at the power costs in individual states. I live in Florida. Our power costs are in line with the with the U.S. average. We produce no natural gas in
Yeah.
Florida. We produce no oil, nothing. But our costs are way lower, mainly because we, as a state, have allowed all these pipelines to come in, bringing natural gas into the state from places like the Marcellus Shale, which of Appalachia, and a state like, and we've also encouraged. If you look at Floridian power generation over time, coal has come down, but natural gas has grown, and we're one of the fastest growing states in the United States for solar as well. But you see, we're growing natural gas generation to support that, so that solar is an intermittent source of power. You produce during the day, you don't produce at night. Battery storage is very expensive and limited. So you have these natural gas plants to back up that solar generation. So because we've grown our natural gas fired power generation in line with their solar to support it, we can do both. A state like New York, you've had this hostility towards nuclear, coal, natural gas, right? And New York should have lower power costs than Florida.
Right, we should. I mean, we're right here. I mean, we
Absolutely.
got that pipeline right to Canada and stuff like that, and they
And from
just yeah,
Appalachia, I mean,
yeah, Appalachia.
Pennsylvania, right next door, very short distance. I mean, Pennsylvania is a heck of a lot closer to New York than it is to Florida.
Florida.
But they won't allow the pipelines to be built. So, for example, in Massachusetts, there's LNG import terminals. They're literally importing liquefied natural gas from Trinidad, primarily, to Massachusetts because they won't build a pipeline through New York to bring natural gas from Pennsylvania.
Right.
In my mind, it's a little bit nonsensical. Natural gas is a very clean source of power compared to a lot of the alternatives out there. And, I think a lot of states are seeing, you can't have 4 times higher power costs in one state versus another, and expect to compete easily. You have population movements going on as a result between different states. So it is very complicated. And I think there are a lot of things in the United States on the infrastructure side that are going to be front and center in the sense that, it's not just about producing more gas, it's about getting it to where it's needed.
Yeah, like energy. Like right now, also, Elliot. I mean, I want to get to your slides too, because I want you to show it because I know we're almost out of time here. But the big thing also that's been affected with energy, people don't realize how important energy is, but like AI is,
Yes.
they need a lot of power. Like Google's and Microsoft, they're spending a ton of money building it, all these data centers and mining for crypto and stuff like that. So people don't, well, what does that mean? So energy is not going anywhere. And I think you need more now than ever. My issue is that these renewables won't be able to handle it. And, as in, if anything's clean, like you say, gases, but like nuclear, it's a totally different world now. It's not like back in the 70s and 60s, we have these monster with Godzilla, those big things anymore. They're very small and compact. I mean, but it takes time to build them. You know what I mean?
It
But
does take time to build them. And one of the reasons that you're seeing so much solar and gas in the United States is those are the 2 quickest things to permit and build.
Yeah. Well, but regarding about your, what I want to hear before we go, tell us where it's going. I mean, is it going to continue to go up? Where do you see oil and gas going as the pricing going? Is it going to stay here? What should we look out for? As an investor, as a trader with your newsletter, what are you telling people what to look for and what we should be seeing going into the future?
So right now, oil is has been kind of in a trading range here for a little bit. I do think that prices this low are unsustainable. I think longer term, you're going to need to see West Texas Intermediate, which is the style of crude we benchmark to in the U.S., trading up around $80 a barrel or higher. I think you will see $100 barrel crude at some point over the next couple of years, simply because global demand is still growing. Absent a recession, it's going to continue to grow. If there is a recession, it's going to dip and then grow again. There's not enough global supply growth to meet that demand. And this first chart you have up here on the screen is kind of a classic example of that. This is from the Department of Energy, the Energy Information Administration, and it's U.S. oil production going back to 1920, January 1920. And you can see that peak in U.S. oil production in the early 1970s. But leading up to that peak, growth was very strong. And we all know what happened in the 1970s, right? Soaring commodity prices, soaring oil prices. And part of the reason for that was there was a complacency, right? In the early 1970s, people were saying, well, our economy is growing at a breakneck pace. Demand for energy is growing at a breakneck pace, but no problem. Look at all this U.S. supply growth, the supply growth from places like Saudi Arabia. When that ended, we went from a culture of plenty to a culture of scarcity. The more recent shift is look what in 2007, 2008, U.S. oil production down around 5 million barrels of oil a day. and there was this culture of scarcity. We're going to have to import more, right? We're going to be more dependent on OPEC. And same thing with gas. When I started in this business, which was 25 years ago, hard to believe, there was the big growth story out there was, the U.S. is going to have to build all these LNG import terminals to import enough gas from the Middle East and Russia to meet growing demand for natural gas. And of course, that hasn't been the case. We saw this shale boom that caused production to soar from 5 million barrels a day all the way up to 13 million. But now I think we're entering another one of those, the top of the cycle where there's a lot of complacency. U.S. oil production, you hear a lot of stories about tremendous growth, but since 2020, U.S. oil production is flat. And you have all these people out there saying, well, we'll see 1 or 2 million barrels a day of additional growth out of U.S. oil shale. I think more likely, and I think this is going to be the big surprise for the energy markets in the next few years, U.S. oil production is going to plateau about where it is.
Mm-hmm.
Maybe you'll see a few 100,000 barrels a day of additional growth, but basically it's going to plateau where it is, depending on the price. And ultimately, you're going to start to see U.S. oil production roll over and go down again, simply because these producers have a fixed number of drilling locations, right, where they can profitably drill for oil in the shale and fracture for oil. And they're not going to burn through those at $50 a barrel oil, but at $80 or $90 a barrel, they're going to produce them at a measured pace over time to maximize free cash flow. You're not going to see what we saw in 2011, 2012 at the early days of the shale boom. It's matured. And so I think that's going to be the big story for the global oil markets, is going to be a supply shock.
Okay.
Not a demand shock. Demand shocks are transitory in nature. Hate to use that word, but they're temporary, if you will. You have a recession, global oil demand goes down. You have a recovery from that recession, global demand for oil goes to new highs. It's always been thus.
Okay.
But the supply side of the equation is, not only can we grow oil production enough to meet growing demand, but also at what price can we grow oil production to meet demand? And I would argue that it's not $60 or $50 a barrel. It's more like $80 or $90 a barrel, or even a little higher.
Okay.
Than that.
So, and where do you see gas going?
Natural gas, I think, is probably a more interesting story in the short to intermediate term than oil. It gets far less attention, but I think it's a more interesting story. The reason is that U.S. natural gas prices are much lower than anywhere else in the world. So, U.S. has an abundance of gas. We're the largest natural gas producer in the world, the fastest growing natural gas producer in the world. We have a lot of relatively untapped shale resources in the United States.
Why don't they use it? Why don't they use it as much? I mean, it's cleaner, it's better, it's cheaper. What are you afraid of?
Well, we are seeing rapid growth in use of it, and to the point that we are now the world's largest exporter of natural gas, because so many other countries around the world are growing their gas consumption so rapidly. It makes sense to take U.S. natural gas, load it onto a specialized tanker, and ship it to other parts of the world, like Europe. And the only constraint on that's caused the price of gas to be relatively low here in the U.S. is that we don't have enough capacity. Building the infrastructure to export natural gas takes years, and permitting, and it takes years to bring. So we haven't had enough capacity to export natural gas. It's not been due to lack of demand. Europe would love to import more gas from the U.S. because it's cheaper than importing it from some other places around the world, like parts of the Middle East. But it's also comes with less geopolitical strings than, say, trying to import more Russian gas. Mm-hmm. But they haven't been able to, because we don't have enough capacity to grow our LNG exports. That's changing. Between the fourth quarter of last year, 2024, and the first quarter of 2026, next year, we saw 4 billion cubic feet a day. We will see 4 billion cubic feet a day of U.S. LNG export capacity growth. Looking out through the end of the decade, you've got at least double to triple that coming online by 2030 over time. So I think you're going to see rapid growth in demand for natural gas, and to meet that demand, and for exports as well, to meet that demand, you're going to need to see gas prices in that $4 a million BTU range compared to two that it's averaged in recent years, the low twos, in order to incentivize producers to produce enough gas to meet all that demand. Natural gas will still be a fraction of the price it is anywhere else in the world, but you're going to need to see prices at a healthy enough level to support that.
It doesn't even sound like a lot when you compare it to oil, right?
No, I mean, there is a difference in terms of energy content. So a barrel of oil has about 6 million BTUs of energy, and 1,000 cubic feet of gas has about a million. So you have to kind of multiply by 6. So $4 gas is equivalent, to roughly $24 a barrel of oil. So even on an energy content basis, it's really cheap. And again, I think it's underappreciated how important it is, because all these places that are building out renewable energy, I often say, solar energy is in many ways a green wrapper for natural gas. It's a way of making gas more palatable, because you need those natural gas-fired plants to back up the solar generation, because solar is intermittent by definition. So in places like China, they're building out their natural gas capacity to support that growth in solar generation that you hear so much about.
Now, Elliott, regarding about your newsletter a little bit. So what are you actually talking about and want people to know in your newsletter, and how, and what do you focus on more on that newsletter?
So in the newsletter, we focus mainly on really any energy commodity. We cover everything from coal to renewables to nuclear power, and we're more focused on recommending stocks that are levered to those trends. We were more in the stock side of thing. The newsletter does have a little bit more of a long-term focus. We do have some trading services that support that, where we do trade individual stocks and commodity ETFs more aggressively. But for the most part, it's a longer-term investment type of publication. Energy and Income Advisor, in particular, we have a hefty income focus. I think a lot of investors aren't aware of the level of dividends that some of these energy companies produce. For a lot of the midstream companies that own the pipelines, we were talking about the infrastructure and pipelines. Some of these companies produce 7 and 8% yields because it's very much a toll booth type of business. They get paid based on the volume of gas moving through their pipelines, irrespective of the commodity prices. But we're also seeing it among the producers. A lot of these producers, they can consistently produce free cash flow at $2.50 or $3 natural gas. The excess free cash flow that they produce when prices are over that, they're paying out as dividends or share buybacks. So we definitely focus on the stock side of things, and it's a little bit more of a long-term focus. But
anything you can recommend now?
Sure. On the natural gas side, I think you can. I think that you can do worse than a name like Expand Energy. Expand Energy symbol is EXE. Used to be called Chesapeake. You may be more familiar with that name. What I like about them is their production is in 2 basins in the United States. They produce out of the Marcellus Shale, which is Appalachia, and they produce out of the Haynesville Shale, which is centered in Louisiana. The Appalachian Basin is the lowest cost natural gas in the United States, the cheapest to produce in the U.S. On the Haynesville side, Haynesville Shale has the benefit of being located in Louisiana. Virtually all of U.S. LNG import and export capacity is located on the Gulf Coast, so Texas and Louisiana. So they're very close to where it's the demand center. Also, a lot of natural gas is used in things like petrochemical production, refining, right? So all of that's on the U.S. Gulf Coast. And it's a heck of a lot easier to permit a pipeline in Louisiana or Texas than it is in Pennsylvania, West Virginia, in the New York State, things like that. So the transportation issue is much easier to solve in Louisiana or Texas.
Okay.
I like them because they have access to both plays. Louisiana a little more expensive to produce, but right there next to all this LNG export capacity. Marcellus, a steady cash cow business for them.
All right, good. Well, this is what we're going to do, everyone. We're going to post up that if everyone wants to get that newsletter and how to subscribe to it. The link's right up there right now. And if anybody here would like to come and join us, we're definitely going to have Elliott come back here, and we're going to do a workshop for you when he's, within the next month or two with Elliott. He'll teach you a little bit more how to read that newsletter, how it works, what to look for, what stocks to trade. Because that's obviously, listen, everybody wants to know. We deal with this every day, so definitely got to know how oil trades, no matter what industry you're in. Any last minute advice you can give anyone regarding about how to trade these markets, Elliott?
The one thing I would say, and I say to people a lot, is to focus on the actual data rather than kind of the narratives you hear in the media, because oftentimes I think they're very misleading. You get a lot of hype around things like solar. You got a lot of talk about this excess supply of oil in the global market.
Mm-hmm.
Well, if you actually take the time and look at the data, whether it's from the Department of Energy or International Energy Agency, whatever, you can often find a very different story or a more nuanced story. So I tell people a lot, focus on the actual data, the actual results from the companies, not so much the spin that you hear.
All right, great. Well, thanks for coming, Elliott. It was really great having you on. I look forward to having you back. So everyone, please take up Elliott on his newsletter and get your phone, scan that QR code, and we'll get you on that workshop. So thanks for listening to another podcast here on Cyber Traders, and we'll see you next week. And we'll get some shorts out there for all of you, and we'll have those up at the end of the day so you guys can watch the recap of what we talked about today. Thanks a lot, Elliott, and